One thing we're not worrying, or we are perhaps worrying, but not enough, is what happens when the new government does take charge. The FY19 fiscal deficit, by all accounts, was met in a stretched fashion. That means the new government that comes in hardly has much sort of fiscal wiggle room available to it. Plus, as you pointed out in your last note, there are the high public sector borrowings, the state borrowings. So crowding out is a real problem in FY20.
Absolutely, and I think this is just manifested in how steep the yield curve is. I mean, where the overnight policy rate is running at 6% now, and there are some expectations in some parts of the market that there could be more easing to come. At least swap markets believe that, and yet the 10-year bond has been close to 7.5%. The old bond for the longest time. That's a very steep yield curve, and that's just reflecting, in my view, the fiscal overhang, because whether it's borrowed by the central government, the state governments, by PSUs, everyone's drawing from the same pool of household financial savings. And secondly, it's reflecting this investment savings gap, that total public sector borrowing is close to 9% of GDP. Household financial savings have been 7 to 8% of GDP, and no wonder there is pressure at the long end. So I think that the biggest risk to an investment recovery 4 quarters from now is going to be how this will be financed, because either a pickup in investment will result in more pressure on interest rates at the long end and therefore some crowding out, or domestic investment will have to be financed by foreign savings and a commensurately larger current account deficit, which would be worrying because it exposes us and makes us hostage to global shocks. So I think the priority of the new government in July, hopefully we'll have political stability, there won't be too much pressure on the July budget, is to go back and ensure that the revenue assumptions for next year are more credible. We had worried in the February budget that the revenue assumptions for the remaining months of 2018-19 itself were a bit aggressive, as they are for next year. This will involve I think tightening GST compliance for sure. Post-elections, it will perhaps need to entail some more tax rate increases and discipline on the expenditure side. So I think it's very important for the new government to stick to this fiscal path, deliver on what was promised in February in a credible way. Because what happens is, even if you end up meeting that number in March, the uncertainty of whether you will meet it or not meet it starts from September, and risk premia get priced into government bond yields for the 6 months going into the end of the year. So I think it's very important that that July budget have very credible revenue targets and have discipline on the expenditure side.
Last word, Sajjid, but if they do sort of stick very, as they should, to the fiscal roadmap that they have put out, will that have a bearing on growth as well? Because I think you were alluding that in the last cycle we saw a fair amount of support from government spending. Will government spending be lower in the next cycle, and hence have a follow-through impact on growth again?
Well, I think we perhaps had a positive fiscal impulse last year in 2018-19, and frankly, with a consolidated deficit of 6.5% of GDP and public sector borrowing requirements close to 9% of GDP, there is just no scope for a positive fiscal impulse going forward. I think the whole point is we're now at a point where enough work has been done that the underpinnings of a private investment cycle are emerging. You are seeing utilization rates go up, you're seeing banks lending again. If global growth holds up this year, we will see a private investment cycle 4-6 quarters down the line. The best thing the government can do to enable that cycle is to retreat a little bit and create the fiscal and financial space that will be needed to finance that cycle. If the government were to again try and drive growth over the next year, then I think we run the risk of prematurely extinguishing that cycle, because really what we need in the next few years is strong, sustained and job-creating growth. The sustained part can only happen if it's led by a private investment cycle. And the job-creating part happens when, along with a capex cycle, I think the government consciously works to make labor a more attractive part of the production function, because what we've seen is a worrying increase in capital intensity in India over the last 2 to 3 decades, which is really worrying because it hurts job creation in a labor abundant economy.